This is the story of War Loan, a bond issued by Britain in 1917 to finance its Great War against Germany. It was issued with a coupon of 5%, but that quickly became unsustainably high, and by 1932 the bond was converted into a lower coupon issue. The story of the bond has seen inflation through the 1970s, and today, with deflation again stalking Europe and the rest of the world, the bond is trading once more at 100, the price it was issued at back in 1917. And the Chancellor of the Exchequer, George Osborne, has announced that on the 9th of March 2015, the bond will finally be repaid. This is the story of that bond. It's a bond we'll miss very much once it's gone. War and government debt have always been very much linked. In fact, the story of the UK's national debt is the story of the wars it's fought in the past. The national debt was created really in the 18th century with adventures in India, France, and the American War of Independence. By the time the Napoleonic Wars ended, UK's debt to GDP was over 230%, which is a level today associated with economies such as Japan and Greece, and a high expectation of default. But peace after those wars led to a rapid reduction in the UK's indebtedness, so that by the time we got to the start of the 20th century, the debt was down to just 30% of GDP. The outbreak of World War I, though, changed all of that, because at least 70% of the UK's economy was going towards fighting the war, and those wars needed to be financed. In 1914, the national debt was £650 million, but by the end of the war, it was around about £7 billion, and it was financed by bond issuance. The first war loan was issued in 1914 with a coupon of 3.5%. The following year, a further war loan was issued with an interest rate of 4.5%. The following year, treasury bills were issued, very short-term instruments, again with a high rate of interest. But the bond we're talking about, the 5% war loan, was issued in 1917, and it came with a very high coupon of 5% interest per year, a rate of interest that even Lloyd George described as penal. But the job wasn't just paying for the war, it was persuading people to buy those bonds. And so began huge propaganda campaigns. How could they persuade a population ravaged by war, feeling austerity, to put all of their savings into lending it to the UK government? As the war progressed, it became more and more difficult for the UK government to raise the vast quantities of money it needed to finance its war effort. One way it managed this was by issuing those bonds and issuing them year after year with higher and higher interest rates, so that by the time you got to the 1917 issue of war loan, the interest rate was 5%. But just as Lord Kitchener had helped recruit an army of soldiers for the UK government, your country needs you, the UK government turned to propaganda to help raise the cash needed to finance its war effort. So there were posters, campaigns and slogans such as this: if you cannot fight, you can help your country by investing all you can in 5% exchequer bonds. Unlike the soldier, the investor runs no risk. 1918 and the war is over. People thought those risks had gone, but in fact they hadn't. The UK economy never really recovered from the First World War, and by the time we got into the 1930s, the UK economy was in dire straits. The debt burden had risen again, and the investor was running a risk, the huge risk that the UK government was about to default.
Each contribution, each assent that is given on this occasion will mean a contribution from the stockholder to the welfare of the country. And when you put them all together, they'll constitute a fresh and striking demonstration of that great patriotism which has so often in our history before shown itself equal to the needs of every crisis.
In their book about sovereign defaults, This Time is Different, Reinhardt and Rogoff identified just 6 sovereign nations that have never defaulted on their government bonds. They are Canada, the United States, Thailand, Denmark, New Zealand and Australia. And you'll notice that the UK isn't one of those, because in 1932 the UK did default. Now, after World War I, the UK never really grew as strongly as the rest of the world. It had a lot of things going against it, not least the big overhang of these war loans. But also, Churchill had made his biggest mistake in 1925 as Chancellor of the Exchequer. He put the United Kingdom back onto the gold standard, causing a big deflationary wave and making it very difficult for exporters to do business around the world. There are also some problems in Europe itself. In 1931, Germany had stopped paying reparations, so there's a knock-on effect with lots of defaults around Europe, including the UK deciding in 1932 that it could no longer afford to make its loan payments to the United States, and it defaulted on a loan of $4.4 billion US. Things were bad. So by the time you enter the 1930s, we have 3 million people unemployed in the United Kingdom. World trade has fallen by 50%, and we also have a huge drop in UK manufacturing output of around about a third. So how is the government going to put itself back on an even keel fiscally? It did hike some taxes for the better off, but the bulk of the austerity came through cuts to unemployment benefit. With 3 million people on the dole, they cut that dole by around about 10%. There are also cuts to the armed forces, and in 1931 the UK saw a very rare mutiny amongst its armed forces, with 1,000 sailors in the British Atlantic Fleet refusing to obey orders, refusing to put to sea, and things were really quite bad. So the UK defaulted on its loans from America, but it also had to do something about the far bigger loan, this £2 billion war loan that was a millstone around the economy's neck, paying a 5% coupon at the time when bank rate was just 2%. How could they restructure that debt?
Before giving you the general news in pictures, we have been asked by the government to broadcast the following. Some of you are no doubt lucky enough to be holders of 5% war loan. May I therefore remind you that this is the last week in which you can obtain the £1% cash bonus for converting it.
Papers have been drawn up as early as 1928, asking the question of how the government could get rid of war loan. Everyone knew that 5% interest every year was utterly unaffordable. But there were 3 million holders of the war loan, and those 3 million holders had suffered through the First World War and had suffered since the First World War as the Great Depression had taken hold. Also, this was a bond. There's a moral and legal obligation to continue to pay this 5% interest. They couldn't simply reduce the coupon without asking the bondholders. What they could do was repay the bond at par at a price of £100. But again, there was a problem. The government simply couldn't afford to do it. So it had a really big problem. It needed to ask permission from bondholders to reduce the coupon, but at the same time it had to ask them whether they wanted their money back. And if they wanted their money back, the UK would go bust. Now, the law officers spent a lot of time advising the Treasury as the right form of words that was permissible under law to allow them to walk this dangerous tightrope between having to pay all the money back and cutting the coupon. In the end, the government got comfortable and they sent out the conversion terms to investors. But Britain was on a tightrope too. Get this bond exchange wrong and the nation would be bankrupt. On 30th of June 1932, the Chancellor, Neville Chamberlain, made an announcement in Parliament and also broadcast it on the BBC. He apologised for the late timing of the announcement and the time of day, and tellingly, that consideration was made for the opening hours of the American markets. They were the new financial masters. He announced that war loan would be repaid on December the 1st for those who wanted their cash back. Those who continued to hold the loan would receive a cash bonus of £1 for every £100 held in the bond, but the interest rate would be reduced from 5% down to 3.5%. He said, "For the response we must trust, and I am certain we shall not trust in vain, to the good sense and patriotism of the 3 million holders to whom we shall appeal." London's capital markets were encouraged to take a few weeks off without any new issuance, and the savings certificate market was suspended temporarily. The task of printing 15 million different forms for the 3 million holders was undertaken within a 24-hour period. They couldn't print the forms in advance because they're worried it would leak into the markets. But this logistical task was actually trivial compared with the propaganda campaign that was about to begin.
There is no doubt, General Seeley, that the scheme is going remarkably well.
Yes, sir, there's no doubt whatever. And I hope that after you have spoken today to those who have not yet converted, it will go even better still.
Well, I should indeed be thankful if it were so, for I regard the conversion scheme as a crucial test of the ability of our country to rise clear of the depression which has weighed us down for the past 3 years.
After the parliamentary announcement, the government propaganda machine went straight into action. General Seeley, the man put in charge of managing the conversion process, got the Sunday papers together in a room for a briefing. He emphasised that the UK was in an existential crisis and only a full or nearly full conversion of the loan would have any positive benefit. He described a full conversion as having a miraculous impact on the UK's economy and in fact on the global economy as a whole. He told them about the letters he'd received from small investors. Even though they were going through hardship, they all fully supported the conversion. The royal family were brought in to support the conversion, and he told them that with inflation so low around the world, the new lower coupon would be worth much more than it would be normally. He also said that just think, what if you'd been a French investor or Italian investor during World War I, your bonds now would be worth maybe 20 pence in the pound. If you were a German investor, you'd be completely wiped out right now. So the conversion, although disadvantageous in some respects, was actually a pretty good deal. Redemption was damnation. Save us from redemption was the buzzword that he told the journalists. He asked them to explain to their readers that if they'd sent in their pink forms asking for their money back, it wasn't too late for them to write in and change their minds. Meanwhile, 1.5 million posters were printed. They were put up in taxis, on buses, trams, in banks, even given out on tables in restaurants. The campaign was supported by W.H. Smith, Woolworths, Marks and Spencer's, and many big companies even printed their own posters saying things like, "We've converted our war loan, have you?" The editors of Punch, the satirical magazine, wrote to the government showing them a cartoon that they'd written with John Bull converting his war loan as requested by Neville Chamberlain and appealing patriotically to the population to do the same. The letter to the government says that preaching to the converted ought to be a great catchphrase to shame members of the UK population who hadn't converted their war loan into doing so. On the letter, crossed out was the word "shame the others" and written by hand, "wobblers." This wasn't just an economic campaign to persuade people to convert, this was a moral campaign. It worked. It had to work. After Bank of England staff worked day and night to process the 15 million forms, more than 1.9 billion of the war loan was converted into the new lower yielding debt. The appeal to patriotism had worked, and actually 3.5% as a new coupon relative to bank rate at just 2% was not such a bad deal, and it was by no means irrational to make the exchange. The conversion saved the nation £23 million per year. Interest payments as a percentage to our GDP fell from over 9% all the way down to 4% in 1940. They rose again during the Second World War, but even in the stagflationary years of the 1970s, when the UK had to go to the IMF for a bailout, interest costs as a percentage of GDP never again rose above 6%. In December 2014, the Chancellor of the Exchequer, George Osborne, announced that all the war loans made during the First World War would be repaid. This was on the 100th anniversary of the start of World War I. He said, "This is a moment for Britain to be proud of. We can at last pay off the debts Britain incurred to fight the First World War. It is a sign of our fiscal credibility and it's a good deal for the taxpayer." I think it is a good deal for the taxpayer. War loan was a very expensive bond to have outstanding. Its yield was higher than other long-dated bonds that the UK could issue, partly because it wasn't very liquid. In fact, astonishingly, there are still 38,000 holders of war loan that have under £100 of bonds outstanding. So getting rid of it does tidy up the UK's finances, but probably only saves around £15 million a year. On his second point though, about fiscal credibility, I think I could have more argument. After all, since this government came to power, the UK has lost its prized AAA credit rating. Its deficits have not improved by as much as those in the Eurozone or in the US, and the government has missed its debt reduction targets as well. So I think it's arguable that fiscal credibility has been increased under the present government. So what is it then that's made bond prices rally so much, yields fall so much? Well, it's all about the global environment. Deflation has come back into the global system. The Eurozone is already in deflation in many areas of the world, making bond yields look more and more attractive. We also have a savings glut, Chinese savings finding their way into global capital markets, and ageing populations which make demographically people want to own long-dated bonds. So a number of things have come together to make bond markets look extremely attractive to investors right now, and that's the real reason that the Chancellor is able to refinance the war loan at current levels. So finally, we can say goodbye to the war loans, not just this one, but all of those issued during the First World War. There'll be no more perpetual bonds outstanding at some point, and we'll miss them. The bond market, the gilt market, will be less interesting as a result. And the story of war loan is the story of the war, it's the story of the restructuring of the bond and how close the UK came to default back in 1932. In fact, it did default on its loans from the United States. It's also the story of inflation in the 70s and where we've got to today with a new deflationary wave hitting the global economy. We'll miss it a lot. Goodbye, war loan.